What's up, everybody? I hope you guys will be doing good. In today's lecture, we will be discussing the most trending ICT concept these days, which is the turtle soup. There is a guy on Twitter, or I must say there is a scammer on Twitter called Romeo. He talks about this concept a lot, and he charges a big amount for teaching this concept. But today, I will teach it for free, and it will of course work better than Romeo's turtle soup, as he himself is a turtle in this market. To understand turtle soup, you need to understand liquidity and the psychology of this market. What is liquidity? Liquidity is the ability of a currency to be bought or sold in bigger sizes without causing significant change in its exchange rate. And in order to do that, we have specific points on chart called liquidity points. Now the question is, why these points are important and why the price has to take liquidity. To make you understand the concept of liquidity, I will give you this simple example. For example, if you want to buy a land, there has to be a seller for that land. Same is the case with an iPhone. If you want to buy an iPhone, there has to be a seller from whom you can buy that iPhone. Same is the case with the currency. In this case, it's euro. If you want to buy euro, there has to be a seller. And these sellers are available at certain points, not at every point. And these certain points, they are called the liquidity points. In this case, the price swept this particular swing low and then it went up. So we say that the price took the liquidity and then it went up. So when we say the price took the liquidity, we mean that there were some orders, buy orders that got executed at this point. Now, why the buy orders got executed particularly at this point? Here comes the psychology of the market into play. Previously, this became the support, the price went up from here. So what the new traders or the retail traders do is, they put their long orders here, okay? They were long from this point and they put their stop loss here because they think this is the support, and once the price breaks this area, the price will go down. So what they do is, they put their sell orders here, and it makes an important selling area. And if it's an important selling area, it automatically becomes an important buying area. So people bought here and the price went up. Now the question is that this is a market structure break. The price closed below an important swing low, okay, on the 4-hour time frame. So it becomes a market structure break, which is an important ICT concept. So why the price went up after the market structure break? This is where the concept of turtle soup comes into play. In this case, this is not a market structure break. This is called a turtle soup. Why we call this turtle soup? Because in trading, the retail traders are called turtles, okay? And in this case, they got souped, which means their stop losses got hit. And the clever traders or the big traders, what they did is, they bought at this point and the price went up. Now the question is, another question arises here, which is, because sometimes a close below previous swing low will be a market structure break, and in other cases, it will be a turtle soup. So if you want to succeed in trading, or you want to become a good trader or a better trader, you need to understand the difference between a market structure break and a turtle soup. So to differentiate between a market structure break and a turtle soup, you need to understand the concept of SMT divergence. Now, what is SMT divergence? So SMT divergence is a smart money tool. Now, in trading, we have some pairs, okay, like Bitcoin and Ethereum, or we have some pairs in the Forex like GBP and Euro. Same is the case with New Zealand dollar and Australian dollar. In indices, we also have SMT pairs, which are NES 100 and SPX 500. These are called SMT pairs. So what happens in these pairs is, if the price of one pair goes up like this, okay, for example, this is Euro. I will write it here. For example, this is Euro and the price is going up. So what will happen is the price of the GBP will also go up, as these two are SMT pairs or correlated pairs, and these are directly related, okay. Same is the case with the Bitcoin and Ethereum. If Bitcoin goes up like this, okay, Ethereum will also go up. You can see the charts. these are SMT pairs, okay? For gold, the SMT pair is silver, okay? So there are many SMT pairs, and some are directly related, some are inversely related. Here we will discuss the SMT pair of Euro and GBP. I will remove it and I will draw again. Let's suppose this is Euro. The price is going up like this, okay? Then all of a sudden, what happens? The price goes down like this, okay? This is the price action of Euro. Now I will draw GBP here. Same is the case here. If Euro goes up, this also goes up like this. Okay, this makes slow. And now the Euro has gone down, so GBP will also go down. Now here you can see that the high was made, this high was made in Euro. Okay, and if you draw this line, you can see that this high got swept here, okay? In Euro, this previous high got swept. And if you look at the GBP USD pair, the price didn't get swept, okay? You can see here the price got swept and not at this point. So this is called an SMT divergence. Divergence looks somewhat like this, okay? It will be either this greater than sign or lesser than sign, okay? And if this divergence is formed at the top, this will be bearish. And if this divergence is forms at the bottom, they will be bullish. In this case, this is a bearish divergence. And in this case, let me show you. The price has gone up. This is Euro. Okay. Same would be the price action of the GBP. You can see this is a bullish divergence. This was a swing low. It is not swept. And here on the GBP, this low got swept, okay? So again, this is an SMT divergence, okay? You can see we got a lesser than sign. This low is not swept and this low is swept. So if we combine these two lines, it becomes a sign like this, lesser than sign. So this is a bullish divergence and the price then goes up. Now, if we come back and look at this chart, you can see that this was the previous swing low on the Euro USD 4-hour chart. So we will draw this line here. So what happened? We got the sweep of this previous swing low and the price closed below it. Now you want to understand if this is a market structure break or if it's a turtle soup. So you will need the chart of the GBP. So here you can see the chart of the GBP USD pair. What happened here is that the price went below the previous swing low and it closed below it. And in this case, in case of the GBP, the price came down, but it didn't sweep this previous swing low. So we got an SMT divergence, okay? We got this greater than sign. They swept this low and it didn't. So if we combine these two, we got this greater than sign like this, okay? So this is a bullish divergence, okay? Now, this is a confirmation that it is not a market structure break. This is a turtle soup. This is just a stop loss hunt to execute some buy orders because the price swept this low, but not this low, okay? Now again, we will look for entries at this area. Now you cannot just enter into trade after seeing the sweep on the one pair and not on the other. There will be some structures that will form on the lower time frames like 1 hour or 15 minutes or even 5 minutes. So we will shift to smaller time frames. In this case, I will shift to the 15-minute. So this is how the chart looks like on the 15-minute time frame, okay? We got the sweep and then the close below this line, and here we didn't get that sweep. So now we have shifted to smaller time frame and we will look for further SMT divergences on the 15-minute time frame, and we will look for entries on the smaller time frames. So here you can see that this low was made here in the Euro, okay? We will draw this line here on the 15-minute time frame, and then the same low was here, and you can see this low got swept. You can see that the price came down and it closed below it. So we got one turtle soup, okay, or liquidity sweep on the 4-hour And now we have shifted to smaller time frame, and you can see we got another SMT divergence or turtle soup or liquidity sweep on the smaller time frame, which is 15 minutes. So we got this SMT divergence, we got this fair value gap. Okay, so I will highlight this fair value gap. So once you get this SMT divergence and then this fair value gap on the 15-minute, this is where you will get your entry. And as there was an SMT divergence on the 4-hour, so it will be a swing trade or a position trade, and the price will go up for days, or maybe it can go up for weeks.